Morning everyone. We've got a full house today of 552 registrations across the African continent, which is absolutely fantastic. For those of us in South Africa, well done for navigating these crazy new load shedding hours. And for those in Cape Town, please do stay safe on the roads in these storms. Thanks everyone for joining the webinar on UK taxation, specifically UK domicility for non-UK residents, i.e. people living outside of the UK, and how this may affect you and your families. For those of you that have registered for our prior Carrick webinars, you will know that these are meant to be educational and cover broad topics and concepts. Everyone's circumstances are very different, so please be cautious to act on anything learned on this webinar. Rather first reach out for personalized advice, as cross-border taxation does have many areas that need to be carefully navigated and considered. My name is Anthony Palmer, Group Commercial Director for Carrick, and I'm joined by Karen Spencer-Smith and Jessica McLellan from Wright, which is a boutique accounting, tax and legal firm in the UK. Karen started her career with the HMRC over 30 years ago and has an absolute wealth of experience in all areas of personal tax. Jessica specializes in tax risk and dispute resolution for high net worth individuals, and prior to Wright, also worked for the HMRC as a dispute resolution specialist. I'm sure you will all agree that having speakers with hands-on HMRC experience adds a whole new dimension to the conversation. Thanks, Jess and Karen, for joining us today. For those of you that don't know Carrick, we are an African financial planning and wealth management business. We are completely independent and take great care in understanding our individual clients' specific circumstances to ensure that we identify gaps in planning and then propose solutions to minimize identified risks while our clients are still alive. This distinction is important as we have all witnessed too many grieving spouses left to deal with a mess that in hindsight could actually often have been easily resolved if planned for correctly. To be able to plan while the person is still alive, ask them questions and gather information is invaluable, and the importance of this should hopefully become evident throughout the webinar. Of course, a key area of financial planning is also to manage your financial affairs as effectively and efficiently as possible while still alive and enjoying life. A bit of housekeeping. Today's presentation should be around 40 minutes, followed by some questions and answers. To everyone that has submitted questions so far, thank you very much. Please feel free to continue submitting more as the webinar continues. If we don't get to your particular questions today, we will certainly reach out to you separately after the webinar. I'm now going to touch on today's agenda and what we'll be covering. So firstly, we're going to look at a high-level introduction to UK domicility. Then we're going to look at how this domicile impacts UK inheritance tax, practical things to consider for estate tax planning, recent changes in taxation of UK property, triggering UK tax residency, and risk areas around UK tax residency. So let's start off with the first point on domicility. Karen, Jess, from my experience, this is a very misunderstood concept and sometimes involves quite heated discussion. Please, can you explain to our viewers what domicility actually is?
Okay, thank you very much, Anthony. So firstly, domicile as a concept is a legal concept rather than one in tax law, but it does have a serious tax ramification for the UK. It impacts individuals that have a connection to the UK. So either parents came from the UK or there's a family connection, or individuals who were originally from the UK and then have settled in another country for their adult life or later on in life. Secondly, the other thing that's important when considering domicile is active connections to the UK and to the territory or jurisdiction that you live in. So visiting the UK, holding investments in the UK, we see families that send their children for education to the UK from abroad. All of those kind of connections and the depth of those connections with the UK are important to consider. So domicile status and the tax ramifications in the UK features in a number of really high value tribunal cases. It impacts income tax, capital gains tax, and also inheritance tax. We have residency and source of income, broadly dictates income tax and capital gains tax obligations in terms of filing, but domicile impacts what's taxed if you do trigger UK residency, and also those IHT ramifications for an estate after death. There are 3 types of domicile to be aware of. One is a domicile of origin. So you obtain your domicile from your father, if your mother and father were married when you were born. Otherwise, you obtain it from your mother. So you look upwards, and likewise, they obtain their domicile from their parents. So that's your domicile of origin. What domicile were your parents when you were born? If your parents changed their domicile before you turned 16, you have what's called a domicile of dependence. Your domicile also changes. And we have an interesting quirk in UK law, which is really quite unfair. If you were married before 1974 as a woman, you automatically obtained your husband's domicile. That one always really irked me, but we now things are more equal. We come across clients less and less who were married before 1974. It's been quite a long time now. Although congratulations if you have been. And we have a bit more equality, gender equality in tax law now, in that women's own affairs and where they live determine their domicility. The other one to consider, the third main important one, is a domicile of choice. So you have a UK domicile of, if you have a UK domicile of origin, have you displaced that with a domicile of choice elsewhere? Now, actually, your domicile is meant to be quite sticky, your domicile of origin. So, for example, if you leave the UK and go and move after university somewhere, and live in that place for your entire adult life, and don't have many connections at all with the UK, you have a good argument that you've replaced your domicile of origin with a domicile of choice. If, however, you move, say you originally moved to South Africa, lived there for 10 years, and then move on to Kenya, live there for 15 years, each time you move, you revert back to your domicile of origin, because the domicile that you've displaced it with isn't strong anymore. It's not there anymore. And that's where we see a lot of people fall into pitfalls, in that they think, I now have a South African domicile of choice. I've displaced my domicile of origin. And if I move to Kenya, it automatically just then flips to Kenyan, or it stays as South Africa for a little while. It's not. It reverts back to your really sticky original domicile of choice. So,
Jess, if I can interrupt you as well.
Yep.
Yeah, that domicile of choice is when is that actually tested?
Okay, so a couple of things would test it. So firstly, if you were to trigger residency in the UK and be wanting to file as a non-dom, this can get a little tricky. If you originally had a domicile of origin in the UK, it's now no longer possible to do that. You're called what's called a boomerang Brit, in that you've returned. So you may have quite a bit of argument with HMRC as to whether you originally had a domicile of origin. And then secondly, it's most vital for inheritance tax, which Karen's going to run through in a little bit. So what is important is what kind of factors the UK tax authorities look at when considering non-domicile status. And this particularly UK property ownership is important. So how many properties, what kind of properties, what size in comparison to your property offshore in a different jurisdiction? Is there an emotional attachment? Is it a house that's been in your family for generations? Do you use it? Is it rented out to a third party and you've never really stayed in this property? And then in the kind of big cases where we have globally mobile high net worths, where their important possessions are kept, they're really personal things. What's considered a home? Where your family lives, and where your close family lives in particular. Your lifestyle. If you're going back to the UK, do you visit there as a tourist, or are you actually more living there in a property that you have there? I've had big investigations where our tax authorities have looked at things like spending patterns, and whether you do the grocery shopping, and whether you're visiting museums and shows, or are you living somewhere. Intention. This used to be a bit of a silver bullet. You could sign a form and say, my intention is to live here for the rest of my days. And that was thought of as a really important piece of evidence for determining your domicile status. But now it's less and less weighted in the courts, and more the courts are looking at the whole picture. So whilst intention is important and it's good to have evidence of it, it's not a kind of get out of jail free card with the tax authority. Other things which contextualize these kind of judgments are how old somebody is, where their economic focus is in terms of investments or career. Have they relied on the UK economy to build a life and make money? And anything that's publicly available. So, for example, I had a case with a client who was very big in the music world, and there were a number of he was arguing he was not UK domiciled, and there were a number of articles where he'd given interviews saying how proud he was to be such a prominent figure in the British music industry and a British artist, and that was something our tax authorities referred to repeatedly. So if you are somebody in the public eye, be careful about what statements you make about how British you feel. So just moving on to the next slide. How is this actually playing out in cases that we're seeing coming to tribunal? So there's been a number of recent domicile cases, but they all tend to be the other way round. They tend to be individuals living in the UK and our tax authorities arguing that they have not retained their domicile of origin from abroad. So, for example, somebody comes to the UK from Zimbabwe and says, I'm going to file as a non-domicile. And after a number of years of living in the UK, 20, 30 years, has a big argument to our tax authorities that they're not still domiciled in Zimbabwe. They have obtained a UK domicile of choice. So it depends on these cases depend on our tax authorities arguing that someone's displaced their original domicile of origin. Those cases show that the tribunal takes a multifaceted approach. They're looking at all those factors I ran through on the last slide. And a lot of those cases, it's difficult, particularly if the individual has died. It's difficult for the family and the executors to demonstrate their clear intentions, and difficult for them to lay their hands on all the facts. Some are really clear, like which territory they have a will in or where they would like to be buried. Others, with the passage of time, evidence is a problem in these kind of cases. It's a shame that we haven't seen a lot of cases the other way round. Our tax authorities arguing that someone's retained their UK domicile of origin and someone saying they've displaced it. I think the cases we have show how contradictory our tax authorities' approach is, in that the things they would use to argue that an individual has not really strong connections, say, with Zimbabwe anymore. Oh, so you own a property there, but it doesn't really matter. Oh, you have family there, but it doesn't really matter. Oh, you visit there, but it doesn't really matter. If you flip that and you try and use those arguments with our tax authorities about having retained your own domicile of origin, they don't give those arguments the same weight. So we have a bit of a disconnection in our courts and cases between the two scenarios, but they should be on the same principle. Okay, so now I'm going to hand over to Karen, and she's going to talk a bit about how domicile status impacts your inheritance tax status if you don't live in the UK.
Thanks, Jess. Morning, everyone. I hope we haven't lost too many of you yet. I think I've been quite interested in what Jess has had to say, so hopefully we haven't lost the attention span too many at this stage. I may lose you now, but hopefully not. I think, as Jess alluded to, I think, there isn't any statute to domicile in UK law, and I think as opposed to how there is for statutory residence, and I think it's important that it's merely a subjective test based on historical case law. And Jess has mentioned the number of interesting cases we've had recently where individuals don't consider the exposure by purely your profile. I think things that the concept of domicile, I don't know if people are aware of the exemptions, but just to mention very briefly, the exemptions in the UK are 325,000 currently for each individual, with an additional exemption if you are exposed to IHT of 175,000 for a nil rate band on a main residence. So a collective married couple would have a £1 million sterling in the UK exemption for IHT. So it's very quickly easy to achieve in the UK because of the price of UK property and other assets, and an amount in excess of the IHT thresholds. And then if you do exceed those thresholds, you have a 40% liability, and on lifetime transfers, potentially 20% liability. So the exposure can be quite material. So it's important to try and protect those. A UK domicile versus non-UK domicile, it's a very difficult subject and something that the Revenue have spent a lot more time and resources to attack individuals. So I think it's important to ensure that you're protected as much as possible. I mean, I think we discussed that the most best risk profile would be not to have any UK assets if there's any risk of your domicile being challenged by HMRC. But that's difficult, as we know, because obviously you may have historical properties, you may have historical assets that have been handed down to you. But I think it's a case of having to take as many steps to protect any exposure you may have if you're anticipating a member of family passing away, or if you're anticipating an inheritance coming towards you, and just to consider how those assets are triggered in the UK. I think we talk about, I don't know if it's on the next slide actually, can I just, would you be able to push on the next slide just to see whether I don't want to duplicate on the next slide in advance? Yeah, okay, so queued up is on the next slide. So yeah, sorry, could you go back and then I'll talk around.
Just to be clear, Karen, because if you are UK domiciled, then all of your worldwide assets fall within the UK IHT net.
Yes,
and
very much
if
so.
you are not UK domiciled, then it's only assets in the UK that you hold upon death that would fall within the UK IHT net. So actually that exposure is really quite large for people. You could have nothing in the UK and be UK domiciled and live offshore and have millions of pounds offshore, and that would be liable to UK IHT if you have a UK domicile.
Yes.
So there's quite a lot of terms on this.
Yeah, so it's interesting. Jess has picked that up because I just assume that people know that. So it's
very, in the UK we do, but
it's a very important aspect. I think one of the, if I pick up on one of the questions which is quite relevant to this, and one of the questions that was submitted yesterday and over the last 2 days, what tax would I be liable on pensions held offshore? What UK inheritance tax would I have to pay whilst living in Africa? So again, Jess's point, if you are potentially UK domiciled, you will pay tax on your pensions, even if they're held offshore. So, and I think it's important for pensions, they may have been built up by historical UK employments, they may have been inherited, and I think it's important to look at the trust deed behind those pensions, if they're very old historical pensions, and ensure that they're written in trust, because that's one aspect, that if they're written in trust, they won't be chargeable to IHT. So I think it's just making sure you revisit historical assets on a regular basis to ensure that you're planning for the current legislation and ensuring that, and I guess Anthony's team could help on that with regards to the offshore pensions, and just really looking and drilling down in some for you to ensure that all your I's have been dotted and your T's crossed to avoid any potential exposure.
So if we step back just for a moment, so if you're somebody who has a lot of wealth offshore and not much in the UK, you are still at risk upon death of your executors having to file an IHT return in the UK for your UK assets, and for our tax authorities to then say, well, hold on a second, you know, we've done a bit of a Google, or we've worked out you might have a bit more wealth offshore. We don't just want to tax you on this small 5% that's in UK. We think you've got a domicile of origin. We're going to, you know, open an inquiry. So that can be a real trigger point, is having that inheritance tax filing obligation upon death because you've got UK assets. So actually the lowest risk, if you may have a UK domicile of origin and it's, you know, you're not sure whether you've displaced it or not, the lowest risk is to have no UK assets and no reporting obligation. So no kind of footstep in the UK at all, no footprint, and no obligation for the executors of your estate to file. That's the cleanest position. A slightly higher risk, or quite a bit higher risk, is if you're non-resident but you've had a period of UK residence in the past, you've got UK assets in your estate, and you've got a history of income and gains in the UK. All of those things give our tax authorities a record for you, something to look at and assess their own risk of your domicile status. So
I think another aspect is if you can't sell those assets, perhaps consider gearing up on them, because the IHT exposure is actually on your net value after accommodating debt. So you could consider gearing up on assets with low interest rates. I mean, obviously there's a cost and there's expense to that, but that is another aspect that clients do sometimes consider. We have offset mortgages in the UK as well, So there are additional facilities that have been coming through recently, just to allow people to manage their sort of assets and funds, UK and worldwide.
So we've had a, sorry.
So just the thing that really gets me is, just touching on my earlier question again. So now you've got UK assets, you've been living in Zambia for the last 30 years, and now you've passed away. And the HMRC starts asking your family members, all sorts of questions and asking all different information.
It's really distressing.
The person to answer that, the best person to answer that, unfortunately, is no longer with us. And that question of intent and, how many times have you visited the UK and keeping records? And I mean, that's, you're a grieving family member. You don't want to, and you might not even have access to that information. So, yeah, so planning now, even if there is a thin tie back to the UK, I think can really be beneficial over that long term.
They can be really painful inquiries, to be honest. They're painful enough when someone's alive and we're looking at their domicile status and arguing with our revenue authorities. We've had a couple of questions through that I can quickly cover under this slide if you'd like me to.
Yeah,
because it ties in quite nicely with the topic. So we've had a question: by just having a UK passport, thus no business assets in the UK, are there still any other obligations in the UK? And this is a good illustration of what we've been talking about. So my first question would be, why do you have a UK passport? Where's that come from? What's the family connection? If you have a UK passport because your mother and father or your father was from the UK, then what is your domicile of origin? It could be that you've not stepped foot in the UK, but you still have a domicile of origin in the UK, and we need to consider that chain through. However, if you have a UK domicile of origin, if there is a risk, you haven't displaced it. And if you've never stepped foot in the UK or don't have a UK asset, you've probably got quite a good argument that you have displaced it. There is that risk of inheritance tax on your worldwide assets upon death. But if you have no assets in the UK, no reporting obligation to file upon death, and it's unlikely the UK authorities would even know about your estate to challenge it. Another question we had: I'm dual British/Kenyan citizen and have property in the UK, although I'm both non-resident and non-domiciled. So the UK tax authorities may take a different view as to whether you're non-domiciled. It depends again on that domicile of origin. If you're dual British citizenship, have you truly displaced? Have you moved away from your connections to the UK? You have property in the UK. What's your connections to those properties? So it introduces a high level of risk in terms of your domicile status, but also having that property means, if it's rented out, you've got filing obligations in the UK ongoing, you have a tax footprint, and upon death, there is that inheritance tax filing obligation by the executors, which highlights the domicile issue for the UK authorities. So automatically, the person in the second question is at a higher level of risk. I thought they were quite nice illustrations of the concepts we've been discussing so far. So handing back to Karen for bits we haven't already covered on practical things to consider.
Yeah, thank you, Jess. We've discussed disposal of property, and we've discussed the obligation to declare those to HMRC and the restrictions based on that. QNAPs are another good vehicle, and I'm sure Anthony would be willing to discuss with any of you the opportunity of QNAPs. And for those that aren't aware, these are qualified non-UK pension schemes and basically retirement vehicles that offer flexibility for holding assets. And whilst unapproved with HMRC, it does allow exemption from UK IHT, but they are particularly complex vehicles. And I would really recommend people, if they are considering QNAPs, to speak to Anthony and his team just to ensure they get them in the right place. You can very easily fall foul with certain advisors who sell QNAPs.
They have to be set up for the right reasons, and they have to be fit for purpose, and there is some pretty nasty anti-avoidance tax legislation that can kick in if tax is the driver. So you have to be quite careful about what you're looking at and why you want to set it up.
Yeah, I think we've touched on, if you're previously UK domiciled, then you could, by returning to the UK, be considered a boomerang brick, which is a term in the UK, which suggests that if you're returning for a short period of residency, it can impact on you again. So it's those collective movements and historical patterns that also expose you. So to consider when you are returning, by all means get in touch with us or speak to a UK advisor to understand the exposure that you could potentially have. I think all areas of tax in the UK are becoming more and more complex. We talk about simplified tax. It doesn't happen, unfortunately, despite the government's suggestion. There are many uncertainties around non-domicile status, IHT in the UK, and just generally domicile because the lack of statutory guidelines to it. So it will be based on HMRC's presence, their resources, and also just the case law. So it's really important to revisit at regular intervals your potential domicile, your movements, and your assets in the UK. I think when we maintain assets remotely, it's very easy to forget about them. Maybe they're not recurring income, we forget they're there, but just make sure you revisit your general assets and wealth.
This warning is particularly important around the concept of domicile in the UK, particularly for people intending to come and stay in the UK and live here and trigger tax residency for a year or two, maybe if you have children in education, etc. We are in a, without getting too political, we're in a period of political turmoil in the UK in terms of who the next party in Parliament will be, and there's been some quite strong statements made about potentially abolishing non-domicile status, etc. So actually now's quite a good time to consider the options and look at this before rules change. I would anticipate when we have dramatic rules changing, there are grandfathering provisions so that anybody that's done anything in a historical way is usually covered, but we have to look at it at the time.
Okay, Jess, over to you.
So from the response we had to the webinar invitation, it appears property is quite a hot topic, and quite a number of attendees still have UK property. So we thought it would be useful to give you a brief update on the changes to property taxation in the UK, particularly for people abroad holding UK property, as there have been a number of tax changes recently over the last sort of 5 years or so. So firstly, something called the annual tax on enveloped dwellings was introduced a number of years ago, and this impacts anyone that owns properties which are wrapped up in a corporate wrapper or a trust wrapper. So if you own shares in a company that then owns UK property, there's an obligation to file an annual ATED return, it's called. And that ATED return either claims an exemption, for example, if the property is rented out to third parties, or it pays a charge if the property is over a certain value. There are a number of people who still haven't realised they have an ATED obligation, and we end up doing quite a lot of disclosures to HMRC in this area. So if you own a UK property in a wrapper, that's one obligation you have. Second tax change was that UK residential property was brought into charge for capital gains, and then a further change also brought commercial property into charge. So if you live abroad or your company abroad owns UK property and sells it, you have 60 days to report a capital gain in the UK. So again, that's a real shift from the idea that if you're offshore and you sell a UK asset, there probably isn't capital gains tax to pay. There certainly is if it's property or land. Very recently, in the last year, our authorities have brought in what's called the Register of Overseas Entities, which ties in with the ATED tax in that any entity owning UK property, any foreign entity owning UK property has to register and tell the UK authorities who the beneficial owner is. And this was because our tax authorities looked at the land registry in the UK and saw that we had 95,000 properties owned by about 32,000 companies. And they didn't know who owned those companies. They could just see that they were offshore, and they were struggling to make sure they complied with their tax obligations. So it's now, you have to register if you have a company or a trust that owns a UK property, and that gives you a number that essentially you can't sell that property without it. You have to have a registration number, and that's an annual, you have to annually update that register. So there's quite a lot of filing obligations for having UK property. If you have a UK property, it may well be exempt from ATED if it's in a corporate, but it's rented out to a third party, like I said. However, if you are a company that's offshore receiving UK rental income, you have an obligation to file a return as a non-resident landlord. And the same goes if you're an individual owning a property directly that's rented out. So you have to look at your rental profits and work out your allowables and what needs to be taxed in the UK. So the practical effects of all of these changes are that the net is closing on being offshore and not being aware of your UK tax obligations, and there are significant penalties. You need to consider capital gains tax and reporting within 60 days on the sale of any UK property. You need to consider, well, you have a reporting obligation if you sell shares in a company that owns UK property. That's considered a property rich company, whereas previously that was a really good way to not have to pay UK capital gains tax. And then there's that rental income obligation to make returns as a non-resident landlord. So at the moment, it's not particularly UK tax efficient to own UK property via offshore structures. A lot of people are doing what we call de-enveloping. They're reversing that and holding them personally because a lot of the tax benefits have been taken away by these recent changes. We've got a couple of questions around this, Anthony, if you'd like me to answer them now.
Yes,
I can run through them
now.
if that makes sense. Yep. So we had a question. How do I file property annual returns and what evidence is needed, for example, mortgage payments? So there are different filing obligations. If it's a company, you've got that annual tax, the ATED, annual tax on envelope dwellings, which is an annual return. You have to file for the exemption. You've got the register of overseas entities that I've mentioned, and you also have to file a income return as a non-resident landlord to pay corporation tax on any of the profits. So a company would have to look at what rental profits it had, what's an allowable deduction for rental costs in the UK and return that. If you're an individual, you don't have the ATED or the Register of Overseas Entities, but you do have to file a non-resident landlord return with appropriate deductions for allowable rental expenses. Mortgage payments, either repayment of the capital or interest, is not deductible in the UK against your rental profits. But there are things like wear and tear, having to call someone in to fix the boiler, agents' fees, etc. Another question we had, if I own 2% or 5% of a property in the UK, is the tax done by the major shareholder not enough? No, unfortunately not. If you have personal obligations, if you own a percentage of the property personally, then you'll have your own filing obligation for your share of the rental profits and the rental expenses. And the same with any capital gains if that property is sold. If the property is within a company, then yes, the company as an entity would make its own non-resident landlord return, its own ATED filing, and its own registration for the Register of Overseas Entities. The only time you as an individual would have an obligation is if you receive dividends or some sort of payment from the company for work performed or sale of the shares. And then finally, one last one on this area. We hold properties in the UK in personal names and wish to transfer into a company. What's the best way to achieve? So in today's climate, this is quite problematic because of the changes I've run through. You would have stamp duty on transferring the properties into a company. You'd crystallise a gain on disposal if you paid less for them than their value at the moment. Not to mention the ongoing filing requirements like ATED, the Register of Overseas Entities, non-resident landlord returns. So my question to somebody would be, what do you hope to gain from having the properties in the company? Is it worth that short-term pain of crystallising quite a few charges? The company would pay corporation tax and it would roll up any profits made until you decided to take a dividend. You could have other family members added as shareholders. But even if you were to sell that company at a later stage as a property portfolio, which is quite, that was one of the benefits of having a company, you could just sell the shares. Nowadays, that would equally attract a capital gain on the sale of shares, even if you're offshore, as it would be a property rich company. So I think you really have to examine what's the driver for doing it and what you hope to get out of it, so we can weigh up the pros and the cons. Okay, so we're now on to the statutory residency test and the kind of risks you may have of triggering residency if you do visit the UK, and then Karen is going to cover this one for us.
Yeah, I'm very conscious of time, so I'll try to speak fast but clearly. I think the statutory residence test in the UK is abbreviated to the SRT. And in 2013, the government introduced a residency test, which is now much more disciplined to allow individuals to navigate their exposure to being resident in the UK. Historically, it was purely opined as domicile is by historical case law and events. Triggering UK residency can be very easily done with habitual visits to the UK, with if children are in education here, if you have properties that you're trying to manage, and I think it has to be very carefully monitored. The SRT really it is quite a complex instrument, and I won't go into the actual detail today because I don't think we have time, but it's basically a series of tests, predominantly 3, which need to be analysed to judge whether you potentially could be deemed UK resident. It will be a combination of physical presence, potentially work days, number of days spent here, ties, if accommodation is available, if minor members of your family are here, and there's a number of ties which need to be monitored to allow you to view whether you could be potentially exposed. I think rather than go into the actual detail, I'll just sort of mention a few salient points as to what could expose you. But the most important thing is you're very disciplined on your day count in coming into the UK. If you are a regular visitor, that's great, but keep a note of your days. And days tend to be counted as those at midnight that you're in the UK. So boarding passes used to be the key, but obviously now passports aren't always stamped as we go through different jurisdictions and coming back into the UK. So I would really encourage people to keep a very clear spreadsheet on your days in the UK so that you know where your exposures could potentially be, so that you then, as you come up to the last quarter of the year, manage your days if they're going to exceed a certain amount. But again, I think it's important, if you do feel there could be an exposure, to seek professional advice, because it is quite intuitive, the SRT, but it can be complex, and there are various layers of it that can expose you. Things like work days in the UK. If you have perhaps an office that you visit occasionally and you spend more than 3 days and you are engaged by that corporate entity, they're considered to be work days in the UK if more than 3 hours. So I think it's very easy, isn't it, in the electronic world we live, to actually be present in the UK and create a UK work day by decisions made and by offices we hold. So I think just be very, very careful on your movements. Jess is eking to get something. Good, Jess.
No, I've seen this in a number of inquiries. Yeah. So our tax authorities would look at things like, do you have available accommodation in the UK? Yeah. Are family members here? Work days in the UK. The 3 hours doesn't just have to be for a UK entity. You could be bringing your own work into the UK. I've had them go through phone records and email record. Residency inquiries can be really painful. So it's key to work out how many days you can stay or visit the UK without triggering residency really clearly. Don't cut it too fine. And seek advice on what ties you have. And then B, if you are spending significant amounts of time, record, as Karen says, keep good records. You don't want to trigger UK residency. It has ramifications for strengthening that case that you haven't displaced your domicile of origin. It has ramifications for personal filing obligations in the UK and paying tax in the UK in that tax year, and it can just be quite painful. So we have a number of high net worth clients who do bounce around the UK, and this is one of the things that we really try and keep them on the straight and narrow around. Big risk area. I
think moving to the next slide, I think we sort of overlap on these slides, and we talk around triggering UK residency by children and partners or spouses living in the UK during term time. Very, very easy to fall foul of it, because you think, well, actually I'm offshore, but family and minor children are a tie within the statutory residence test. So again, it's very, very important to monitor that movement. Regular visits to the UK, they become of a habitual nature, and if we don't have a robust process for day count and documentation, we can fall foul if HMRC challenge your movements. And with the international exchange of information now, it's amazing how many people fall foul of that footprint being very easily identifiable in the UK. I think any form of business interest should be monitored. I think the protective step of ensuring also that your home, if you have a home outside of the UK, that you spend at least 30 days there, because again, that's another test that leads you to suggest, the revenue suggests that actually, are you spending more days in the UK than you are in any other jurisdiction? So again, it's just better to protect against UK residents. One aspect that I see that some clients will find out is a temporary non-residence rule. So many will move out of the UK after being here for a number of years. The temporary residence rules in the UK suggest that if you're out of the UK for 5 years, you're not actually non-resident. You may manage your days, but you're still only temporarily non-resident. So during that 5-year period, if you was to return and you've had income or gains, then they immediately come back into charge. So again, it's just another small point of the statutory residence test to think, I've left the UK, I'm no longer resident, but actually if you come back within a 4-year period, that whole period, the income and the gains become back into charge as a UK resident. So I think it's just a case of managing the presence if you are leaving, to ensure that you do manage the five years, 6 years for inheritance tax, and again that you seek professional advice. Because I think people feel once they've moved and they're no longer here, that's fine, I can just return back to the UK in a few years' time and there'll be no exposure. But that income and gains in that intervening period do fall back into charge. So it can be a nasty shock for someone coming back into the UK. They may have to come back early for family members or for, you know, unwell relatives. We can't dictate our life by tax, but we can manage the exposure that perhaps, you know, perhaps would be there if we don't mitigate our movements and manage our movements. So I think we had another question as well, which is a question as, let's make sure I'm picking up the right question so I don't duplicate. Jess, did you pick up the African living in Africa to pay capital gains tax if he owns property? Have you picked that one up already?
No, I haven't. It was, is an African living in Africa required to pay capital gains tax if he owns property or invests in the stock market in the UK?
Yes, so very much so. So it is a good question. You are required to pay capital gains tax on any UK residential property. Unfortunately, UK non-residents were brought into the net a few years ago within the changes. So there is an obligation to declare. I think there's a very tight deadline as well, 60 days. So 60 days goes very quickly, doesn't it, when you sell a property and you're managing the after effects of that. So that has to be managed. And Jess has mentioned already, the UK stock in the UK markets is a chargeable as well as a capital gain, even though you're non-resident.
If you own shares in a property-rich company, it is. You have to look at, we'd have to look at the source of shares and your residency pattern to determine which gains were chargeable or not.
And if we just touch on this question on the stock market, so you know the concept of situs tax, so any assets that are on site in the UK, we've mentioned property, but something that a lot of people overlook is bank accounts. If you've got money in a bank account in the UK and you pass away, that's a situs asset. If you own shares of UK companies, where the company was incorporated in the UK or on a share register in the UK, that's a situs asset. And you know, when you pass away, will be caught in that inheritance tax net and 40% inheritance tax over and above, you know, the £325,000 threshold. So unfortunately, situs tax is something that catches people, and that's got nothing to do with your domicility. That's purely where those assets are located.
Yeah. So even if you're UK non-UK domiciled, if you have UK assets, as Anthony says, a bank account and shares, a property, they fall within the UK IHT net. If you are UK domiciled, it's not only the UK situs assets, it's all of your worldwide assets. So that net widens even more. Okay, let's move on. I'm aware of time. We've got a really quick case study here that hopefully illustrates some of the principles we've been talking about. So we've got Fred. He's 55 and lives in South Africa with his wife and children. Fred was originally from the UK, so a UK domicile of origin. He left shortly after university and intends to stay in South Africa for the rest of his life. He's worked and lived in South Africa ever since leaving the UK. So a good 30 plus years, but he does visit the UK 2 to 3 years for 2 weeks every couple of years. He owns 5 properties in the UK and has a small pension fund from First Royal University and some family in the UK. So Fred clearly has a filing obligation in the UK, an income tax and gains filing obligation in the UK as a non-resident landlord, because he's got those rental properties, and when he draws down his pension. we could make quite a strong argument that he's displaced his UK domicile of origin with a South African domicile of choice. He intends to stay there for the rest of his life. He's built his life there, his career. His family are all there. You know, nothing in that fact pattern at the moment. If we were standing in front of a tribunal, going back to what I was saying at the start, nothing in the fact pattern at the moment isn't a strong indicator. But let's look a bit deeper at the context. So what if all the 4 properties are rented out, but one is the old family home? It's kept for sentimental reasons. Fred has a lot of his family antiques there, and it's available accommodation. He stays there whenever he goes to the UK. That's starting to feel like a much stronger tie, like a much stronger connection to the UK. You know, how does that rank against the property he has in South Africa? Or the other end of the scale, what if all those 5 properties were rented out? They're new build flats. He has no connection. He's not even stepped foot in any of them. He bought them all off plan. You know, and he also has a similar number of rental properties in Germany and France. It's just part of his overall investment strategy. It then suddenly starts to lose its significance if you're arguing about that balance of judgment. What if his will says he's going to be buried in a family pot in the UK? That's very different from intending to spend the rest of your days and after the end of your days in South Africa. What if his children decide to go to school in the UK? His wife goes there to live with them whilst they're younger. And upon 18, they go to university, they stay in the UK, they have children in the UK. Fred is suddenly moving back and forth a lot more to see his grandchildren. Again, a much stronger connection. Or what if the family in the UK are his elderly parents? And in the years coming, they need more and more support. So he spends more time over there. Or the other end of the scale is they could just be distant cousins that he sees once every 3 years. And perhaps his close family, his parents and his brother, are also in South Africa. So you can see where we're going back and forth on the scale here. And I'm using these as examples to show you about how they inform our judgment about that strength of connection. What if Fred was 40 rather than 55? When you're 55, you're approaching in the next few years key events like retirement, events that HMRC would argue would trigger if you're going to leave a country, you do, or if you're going to stay in a country for the rest of your days, that you do. So the older Fred is, and the longer he's been out of the UK, the more solid an argument we have that there's really a substantial displacement of his domicile of origin. But one single fact can flip this on its head. So we have to be really careful about monitoring throughout a person's life what their domicile status is in order to not leave that mess for executors and the rest of the family to face if IHT is an issue. And I suppose what I would say if I was sitting in front of Fred is, how valuable really are those rental properties? You know, how important is it to keep that as part of your investment portfolio? Because actually, if you get rid of them and you don't have a need to file in the UK for rental income, and you don't have a need to file for inheritance tax upon death and spark interest from HMRC, you know, is it worth it? Is it so commercially viable that it's worth it, or are you best realising a gain and investing your money elsewhere? It's a valuable consideration to make, and for some people it's one way, and for other people it's the other. All of this is about considering risk and making an informed decision rather than not knowing where you stand.
I remember reading some case law, you know, people that had never stepped foot in the UK were actually, you know, domiciles. People that had planned brilliantly and their kids decided to scatter their ashes over the White Cliffs of Dover. That was enough to tip scales. So I mean, yeah,
I don't think just the scattering of ashes enough, but that no. It is quite symbolic. But you're right. You know, if you had somebody that lived in South Africa for 10 years and then moved to Namibia for 10 years and then Kenya for 10 years, and then, you know, all the time they're reverting back to that domicile of origin. And if then their ashes are scattered in the UK and they still had UK property that the kids had a connection to, and that the family went back and visited a lot, you know, you're suddenly getting a weaker and weaker case because there's no alternative. You can't say that South Africa or Namibia or Zimbabwe or Kenya displaced that connection to the UK, because that individual, although they were outside of the UK for the majority of their life, never had a strong enough roots in any of those places. There's a very recent case about a guy who moved to America and flipped between 2 different states in America. And it was decided he hadn't displaced his domicile of origin in the UK because he hadn't established a firm enough connection to either, to the first state, because he'd moved to the second state. So it's judgmental, it's complicated, and it's very, very personal, is what I would say. That's the note I want to leave you on. It's not a one size fits all.
And how fair are the HMRC when they look at these cases? I mean, the obvious logic is to say they're going to always tend to get more inheritance tax because everyone wants more tax. From your experience working in there, are all both sides of the story weighed up and a fair judgments made?
It's painful. It's painful, and you get caught up in a policy drive of what kind of cases they want to take to tribunal to fulfil the direction of travel of what kind of decisions they want to get to enforce a tax authority policy on domicile position. So I've had some really tough cases, particularly around people, say, coming to the UK after the Second World War as refugees from certain countries and not being able to keep up connections, and our tax authorities have taken a very hard line on arguing that they've obtained UK domicile of choice. I've also had an individual die in the UK in quite tragic circumstances. He fell ill when he was in the UK and had never lived there. He'd originally come from the UK many years ago, lived outside for 40 years, 50 years, returned to the UK and was diagnosed with leukemia, very, very aggressive leukemia. And within a couple of weeks found out he couldn't fly, couldn't catch a boat, wouldn't even take him home to his home country. And he died in the UK. And HMRC were pretty strong on a case that he had obtained a UK residency and he'd reverted back to his UK domicile of origin for IHT. Sometimes circumstances arise that you haven't planned for, and all you can do is the things you can plan for is mitigate the risk. But they're hard cases to argue with HMRC.
I think I just add, today's been sort of tax focused, and we don't want to paint such a bad picture of investing in the UK. We don't want to discourage you and paint such a bad picture, but I think today is just about raising awareness from our perspective, and we are naturally cautious as accountants, but I think if you had a fact sheet that just ensured you didn't tick the relevant boxes that HMRC are attacking, that can be quite a good proactive step to take if you're concerned. And just get in touch and say to us, what can I do to perhaps protect myself against this? And Jess, having been with HMRC, is very experienced in thinking what the revenue are actually looking for and what you can do to protect that. So don't think you can't invest in the UK or can't hold assets, but it's about making sure you don't tick all those boxes that they're looking for. So I don't want to paint such a bad picture of the UK. It's a great place to be and invest. So
great. All right, thanks, Jess. Thanks, Karen. Really, really insightful. I think we should start wrapping up. We had a lot of other questions from the participants, which we're not going to unfortunately have time. So as I mentioned earlier on, we'll reach out to you individually. So let's just take the last couple of minutes to summarize what we have touched on. Certainly domicility and the fact that you can get quite easily caught up in an IHT net. Even if you've been living outside of the UK for many, many years. We spoke about the potential tax ramifications of investments in the UK and visiting the UK when you've got family connections there. We've discussed issues to watch out for around inheritance tax, ownership of property, the time that you spent in the UK and movement between other countries. Hopefully the point came across that you have to be proactive in sort of talking about these issues, raising them, rather than just waiting for an event and then there's a big inquiry and you're no longer around or you haven't got the information available to answer that inquiry. And finally, we've touched on the fact that it is imperative to keep evidence and documentation of any time that you spent in the UK. Obviously, if day count is an issue, if you go for a couple of days a year, it's not going to be an issue. But if you do spend more time there, please keep evidence. I'm sure that a lot of these points have touched a nerve with some of the listeners. So if you want more information, please reach out to your Carrick wealth manager or email us on webinar@carrickfs.com. That's webinar@carrickfs.com. I think once again, I think just a very, very big thank you to Karen and Jess for their time. They really are experts in this field. I learn new things every time I hear them speak. And to all of our participants that took the time out of their busy schedules to log in today, thank you all very, very much. I hope that you took something and learned something from it, and wishing everyone a great day further. And thank you very much.
Thank you, Anthony.
Thank you.